956 is our investment of earnings in U.S. property. And that's what I was referring to before when I talked about the 951A1B inclusion, which is focused at properly deferred income, deferred earnings and profits, so to speak, that are improperly used and as a result under 956 create a current inclusion in income because of the use somehow in the United States of those earnings. Again, the concept is that if these otherwise deferred earnings are used in the United States, that's the equivalent of a dividend to the parent, and therefore you hit the parent with an inclusion in income under 951. Organizationally, 956A is how you calculate the inclusion in income. 956B is the definition, which is essentially earnings and profits with some adjustments. 956C, which is key, is what is an investment in U.S. property, and that's the principal one we want to look at. And then lastly, we'll see there's a rule regarding pledges and guarantees of obligations of U.S. persons. That's the one I was referring to earlier when I said that a company could relatively easily trigger a Subpart F inclusion in income or a 951 inclusion in income when it wants to. So, what is U.S. property? 956C and D. Okay, there's a few general categories. Obviously, a tangible property located in the U.S. is going to be a major one. You can't have the foreign company invest in U.S. real estate. That would be U.S. property. Stock of domestic corporations is U.S. property, but there's a big gaping hole there, which we'll get into shortly. If the CFC loans money to a U.S. person, or the CFC is a pledger or guarantor of a loan. Again, the loan could come from a third party. All the CFC has to do is just, guarantee the loan or pledge its assets for the benefit of the creditor of the parent, and you have an investment in U.S. property. And notice the right to use intangible assets in the U.S. Well, that's an especially interesting one, as we'll talk about in a moment, because of what's not there. Implication is you can own intangible assets that are for use outside the U.S. Doesn't say anything about who you buy it from. And again, numerous exceptions. For example, bank deposits. The CFC can put money in a U.S. bank. That's not a problem. If it's purchasing property for export, it can, of course, own physical inventory that's still sitting in the U.S., awaiting shipment overseas, that sort of thing. Okay, so the obvious question, which gets back to Ricardo's question from last week, is what can you use your money for? What uses can you have that are appropriate, so to speak, and that do not cause an investment in U.S. property. So the first one is really very, very large. A loan to a related CFC. So, or a stock investment in a CFC. The point is that you can use the funds to finance any operation or any asset outside the United States, even assets that will be owned by related CFCs. Now, notice this one's kind of interesting because in theory you might say, well, gee, if the U.S. really wanted to be strict about this, they could say that that any investment or loan would have to be considered to go first to the parent as a distribution and then as a new investment. But the rules don't require that. So it's very easy to use the accumulated earnings, you know, these that are have the benefit of deferral, to use these earnings in other group members that are outside the United States. Now, I said a loan to a related CFC or a stock investment in a related CFC, but that, of course, I could have written it broader and said any foreign corporation as opposed to just a CFC. So it could be a loan to any unrelated foreign corporation. Now, notice the distinction. Let's say we make a loan to an unrelated foreign corporation. The basic deferred profits that we've accumulated are not put at risk at all. The interest that we receive on this loan, that will be foreign personal holding company income and perhaps be immediately brought up as a U.S. shareholder inclusion. But the basic principle of the loan is not a problem. It's only the interest on the loan that becomes foreign personal holding company income. So it's sort of, we're protecting the crown jewels, this large amount of untaxed or low-taxed income inside the foreign corporation, inside the CFC. The third one, which I referred to before, purchase or development of intangible property to be used outside the U.S. Well, why is this one of interest? Well, if we think about Cisco, or we think about Google, or any one of the pharmaceutical companies that have produced wonderful intangible property inside the United States, this means that we can have the CFC that has built up a bunch of low-taxed or untaxed earnings buy the non-U.S. rights for these intangibles. That gets the money back into the U.S. and it gets the intangible property, which is at the heart of earning a whole lot more income outside of the U.S. in foreign solution. So this is, again, part of the environment that allows the Cisco and Google and so on that have been very successful at, in a sense, gaming the system and achieving very low effective tax rates on a worldwide basis. Notice the fourth one, minority stock or debt investments, where the ownership on a cumulative basis, this is one of these areas where the test is not on an entity by entity basis, but is on a group basis, where if the group owns under 25% of the corporation into which the CFC is making the investment, and again, that under 25% is after the new investment, then that's okay and is not a problem. And lastly, a pretty broad ability to loan money to persons other than corporations who are not U.S. shareholders of the CFC itself. So with these sorts of rules, there's enough flexibility so that there's a let's say pretty effective use made of a lot of these overseas earnings. And at least in my experience, it's normally been by either intention, in other words, they want to trigger a dividend, a Section 951 A1B inclusion in order to get the deemed paid tax credit. It either happens because of that, or they inadvertently just make a mistake, and somebody operationally does something, and they only find out the damage at the time the tax return is done. For example, how are these kinds of things discovered? I remember one client. This was when I was living in Houston. I had one client that was sort of a Texas good old boy, and he had a company that I can't even remember the business, although I can picture the guy. They had a subsidiary somewhere overseas, and I'm reviewing the draft financial statements from a tax perspective, and I read the footnote on debt obligations of the company, of the group, and it says, well, this particular obligation to a bank is guaranteed by the subsidiary in whatever country it was. So, this was the kind of inadvertent thing that you find out after the fact, as opposed to planning for it. But these rules are such that, like I say, it's either you plan it or somebody just makes a terrible mistake.
So was the subsidiaries loan?
No, well, a bank, either a bank or somebody had made a loan to the parent company, and the subsidiary had guaranteed the loan, because the subsidiary, of course, had a bunch of liquid assets in it from having successfully, had earnings that were not subpart F earnings, so that there was deferral involved, and that was an expensive mistake. It was a good lesson to the client from the standpoint that, before he does things, he should speak to his advisors.